In this week's video, we'll show why the charts and the hard data are telling us that bear market risks are increasing at a rapid rate. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In 2016, the bull market is on the ropes, but it's not dead yet. We'll cover key areas of possible support. We'll look at the accuracy of stock market forecasting and take a step back and look at the CCM market model from a perspective of objectives, our time frames, and how we handle difficult periods. MarketWatch headline Friday, January 15th, stocks post worst 10-day start to the year in history. That's a strong statement. The recent action in the markets should be respected. Sometimes in the markets, we do not know the whys until later. For example, the situation in China could be worse than the market originally believed. We have no idea what's going to happen next week, but we do know this, and we're confident about it. The current risk-reward ratio in the stock market is much lower today than it was even 3 or 4 weeks ago. This is the NYSE Composite Stock Index. This is November 21st, 2008. Those of you that are familiar with technical analysis can see that this is a topping pattern potentially, a left shoulder, a head, a right shoulder, a neckline. Point of the exercise, the first time that the weekly chart closed below the blue neckline, very bad things happened after that. This is the first close here. In this example, and this is just an anecdotal example, it doesn't mean that's what next week is going to look like in 2016, but it does speak to probabilities. The next week never really pushed any higher than this close, and then after that, it was very, very difficult. From this close here to November 21st, the NYSE Composite dropped 42%, and those of you that know your history know that's not even the end of the bear market. It fell further into calendar year 2009. Let's fast forward to the present day in 2016 as of the close on Friday, January 15th. Similar situation here. Here's your head and shoulders potentially. This is your downward sloping neckline. We had the first weekly close below the neckline this week. This is similar to this point right here before stocks dropped 42%. I can't emphasize enough. We're not predicting a 42% drop in stocks. We're just noting that the probabilities today are worse than they were even a week ago when we were above the neckline. Stocks very well could rally from this point, so we'll head into next week with a flexible and open mind. Like the last chart, the NASDAQ chart has something that we did not have a week ago, so it looks worse from a probability perspective. It retraced this entire move. These are the fibs here. It went back to the 100% level and closed below it. It also closed below the lowest closing low from August of 2015. You can see right here, the close is below all of these lines. It simply speaks to probabilities. You can make an argument that this is a left shoulder, this is a head, and a right shoulder may possibly form. This is one reason to keep an open mind about the bounce scenario heading into next week. There's nothing earth-shattering about this chart, but it does speak to the weight of the evidence. S&P 500 weekly, Friday, January 15th. We made a new weekly closing low below the low made in calendar year 2015 here and below the low that occurred in October of calendar year 2014. As we noted last week, we had step 3 for the trend change, and we can clearly see a lower low on the weekly chart here. This is starting to look like a weekly downtrend. We're not big fans of forecasting, and these comments will not impact anything that we do, but it is good to know what the future may hold from an implementation perspective. You can estimate a target from a head and shoulders topping pattern. In this case, the target would be down at this level here, telling us there may be more white space to fill in the weeks and months ahead. Ugly looking charts and situations with poor risk-reward ratios can begin to improve at any time, which means we always keep an open mind about all outcomes. This S&P 500 daily chart as of the close on Friday, January 15th, will help us keep an open mind about the bounce or bullish scenario. These lows here from August of 2015, the intraday low, we were able to close back above it. This also speaks to probabilities. We made a lower low during Friday's session, but as long as we hold above this level, the probability of a bounce is reasonable. If this level is clearly exceeded, which is 1867 on the S&P 500, the longer we stay below it, the more concerning it becomes relative to the head and shoulders patterns and the break of the necklines. As long as we stay above this, the probability of the plunge obviously would be lower. The previous chart was glass half full. This is glass half empty. Support for the S&P 500. Support. We broke support. And after that, we made a lower high and a lower low. S&P 500 weekly, left shoulder, head potentially, right shoulder. This would be your probabilistic target here in the 1700s. We closed Friday, January 15th at 1880. Risk on versus risk off, SPY versus TLT long-term treasuries in the ETF world. Support for the ratio, support for the ratio, support. We have broken support, which also speaks to probabilities. When you have a red day in the markets, as we did on Friday, it's more concerning when people are running away from stocks and also running toward more defensive ETFs. These are the 3 ETFs that we featured in last week's video. All 3 of them were green during Friday's session when stocks were red. Regular viewers and clients know that if we understand what maximum fear looks like 2008 and when confidence turns, what that looks like in 2009, we can better understand the cases that fall in between. Here's this same weekly chart with the same moving averages. The present day looks more like this than this, which speaks to probabilities, and you can also see the lower low on a weekly basis. Same concepts, we're just using weekly charts with longer duration moving averages as a reference point so we can see incremental changes. This is the chart roughly a year ago. This is January 23rd, 2015, and you can see we have a strong trend with the dotted moving average on the bottom, dotted on the bottom, dotted on the bottom. 2008, when things aren't going well, dotted is on the top. Same chart as of Friday, January 15th. You can see here off of this low, we eventually get the dotted moving average on the bottom, which looks bullish from a probability perspective. We said we were near an inflection point, and now we've flipped over where the dotted moving average is now on top. All of the slopes are down and price is below. The dotted moving average is on top, all the slopes are down, and price is below. Does this mean that we're going to get a look like this? Absolutely, positively, no. It just tells us that the probability of good things happening with a look like this is quite a bit lower than the probability of good things happening with a look like this or this that we had just a few weeks ago. Since there's no magical input or ratio or moving average, the market model is highly diversified. We've covered this in the past. This is monthly stocks versus bonds. This is what a bearish rollover looks like in the year 2000 after that bad things happened. Here's what a bearish rollover looks like in the year 2007 after that bad things happened. Here's the same ratio in April of 2015, and you can see it looks much healthier. If we fast forward to the present day, and since this is a mutual fund here, this close is actually as of Thursday, January 14th, but you can get the idea. The chart looked much, much better in 2015. Now price is below both moving averages. Blue is below red and the slopes are down. Price is below both moving averages. Blue is below red and the slopes are down. Doesn't mean we're in a bear market. It just tells us that the probability of flipping over into a bear market is higher today than it was even here in November or December of 2015. In last week's video, we said it was a good time to check your bear market contingency plans. After that, the S&P fell over 2%. We believe from a probability perspective, this is still true. In terms of where do we go from here, the rest of the video will cover how the model works from a conceptual perspective, and will let us know how we will handle the bounce case in 2016 or the case where the neckline is broken. We don't have a preference for what happens. We just want to have an open mind, pay attention to the data, and allocate accordingly. So long-term chart of the Dow Jones Industrial Average. This is 1900. This is the present day here. Two major points that relate to trend following and the model. The bias over the long term, the green line, is for stocks to rise. And therefore, when the odds are in our favor and mathematically we're in a bull market, we give the bull market the benefit of the doubt until proven otherwise. Why? We want to capture the long-term bias for stocks, which tends to be up. However, we also know that there can be extremely painful periods, and from an opportunity cost perspective, maybe a better place for our capital. Therefore, when the odds are not in our favor, we want to reduce risk and look for opportunities in other areas. Why is risk management so important? Stocks tend to go up over time, but in this case, it took 26 years just to get back to break even. For clients, it's extremely important to understand the basic concepts behind the model and why we do what we do. Why is it important? Because the more we understand about how the model works from a basic perspective, the easier it will be to stick with it through difficult periods. So we're going to cover 4 periods in history and then rip them apart so we can understand why we're doing what we're doing in the present day. This is 1993 S&P 500, 1994, all the way into early 1995. This is a difficult period. This would be a very difficult period for the model and a frustrating period, very, very similar to the last 2 years. Case B, we've covered before as well, 1999, 2000, early 2001, S&P 500. When we take a step back and pull this apart in terms of the way the model looks at things, we'll understand why in some cases the model will add to risk here and then cut risk here, which in these cases you're adding high and cutting low, and that can be extremely frustrating, and that's not really what we want to do, but there's a reason why we do it, and we'll cover that in this video. It's important to note these concepts apply to all markets. They're not specific to this period. Trends are trends. Markets go up when the net aggregate opinion, relative to all the fundamentals of the day, when the net aggregate opinion is bullish, prices tend to rise. When the net aggregate opinion is bearish, they tend to fall. That's true in 1902, 1906, 2001, and 2006 2016. Another difficult period here where when you're looking at this chart, it could be extremely frustrating. S&P 500, 2002, 2003. You appear to be adding at high levels and cutting at low levels. This is obviously not what we want to do and frustrating. Going back to case A, in the present day, if you're only looking at a chart like this and you're only thinking in this time frame, it becomes very difficult to see the bigger picture. Before we take a step back, keep in mind we're starting in 1993. We're going to early 1995. So I'll box off case A here, 1993 to early 1995, and then we'll also look at this period from the model's perspective using one example to illustrate concepts. If we're in this period here and we're only thinking in the short run, yes, it's frustrating. You're adding here at higher levels, you're cutting here. You might have added a little here, cut a little here, you're getting whipsawed. It's costly, it's insurance, and it's frustrating. However, at some point, if you continue to execute, you will be adding at higher levels, and then a trend will form. If we get to this level here, and we assume that we know what's going to happen, we might make that assumption here and miss this move. We'll show later in this video that nobody can accurately predict what's going to happen. It's a proven mathematical fact. The further you go out, the more difficult it becomes to make accurate predictions. Therefore, consistent execution is what enables you to eventually get with the trend. And you'll notice in this period in history, this is the exception to the rule. It's not the rule. Typically, the market is trending in one direction or another, and consistent execution will get you properly positioned when the next trend starts, whether it's up or down. The basic premise of the model is to get properly aligned with a trend, whether it's up or down, and then discern between volatility to ignore, volatility to ignore, volatility to ignore, volatility to ignore, and eventually you get to a point where mathematically you get to volatility to respect and your trend goes down. Now this is the volatility to ignore, this is the volatility to ignore, and this is the volatility to ignore. How does the math help us filter out all of this noise and all of the human emotion and ego-related issues that come into volatile markets? The model is designed from a longer-term view. We've taken the exact same chart, we've added in the 50-day moving average in blue and the 200-day moving average in red. The 50-day helps us with intermediate-term trends, the 200-day with longer-term trends. This is day-to-day noise. Instead of looking at all of this day-to-day noise, the model looks at hard data that helps us stay focused on the trends. Now this is starting to look a lot easier. We're filtering out the noise. We showed case A earlier, starting up close in 1993 and moving into 1995. The early stage, mathematically, is relatively easy. The 50-day is above the 200-day the entire time. The slopes of both of them are up. And for the most part, this is a bullish, leave it alone, ignore the volatility trend. Once we get into 1994, it gets more difficult. And this looks a lot like the present day. In the present day, the 50-day went below the 200-day. We've gone back above it. The only difference is now we're back below it, but it's still very similar. If you were executing day to day here, it would be very, very easy to get discouraged and to get rattled. If you continue to execute, it typically starts to get easier. In the present day, it might be in this direction or in this direction. This is a difficult period. Look how much easier it gets mathematically. Blue stays above red almost this entire time. We get one little whipsaw event here. This is 1995 all the way to the year 2000. And for the most part, we have discernible bullish trends from a mathematical perspective that helps us filter out the volatility to ignore. So when we're in the present day, we are thinking about the longer term. And the model is allocating in a way it wants to capture the next long-term trend. And sometimes to get there, it involves frustration and whipsaws. But as you can see here, that's the exception to the rule, typically not the rule. Zooming back in case B, this is the noisy day-to-day look where it's easy to get rattled and to let your emotions and ego start to affect decision making. How does the model look at a period like this where it's very, very frustrating and it looks like we don't know what we're doing at times? Here's case B from 30,000 feet where our emotions are much, much easier to control. It's much easier to look at this and say, this really doesn't look that hard if I take a step back. And it isn't that hard. The hard part is remaining disciplined and dealing with the day-to-day volatility and human emotions and swings in your account balance. In this case, the model is trying to get aligned with the next trend. It doesn't know which way it's going to be here. It treats this period the same way it treats this period. It's indecisive. We don't know which way it's going to break. The data will get us in the right direction. What do we mean by that? The data doesn't miss this move. This is observable. I can see it. I can measure it. I can allocate based on this look. The data doesn't miss this move. I can see this. I can measure it. That's not the difficult part. The difficult part is being able to take the step back and understand what our objective is, to ride this trend and to catch this trend, and then to catch the bottom here in 2003. And you can see with these two moving averages, and there's nothing magical about them. We chose these because they're common moving averages. The model uses them, but they're not heavily weighted. They're not big factors in what we do, but they work for illustrative purposes, and the concepts are the same for the most part across the model. Let's assume the model was allocating towards a defensive stance here, and we get this sharp counter trend rally. It would appear that the model was making mistakes. But when you take a step back, from a trend perspective, you can't even see this frustrating and emotion-inducing counter-trend rally that started in late 2000 and carried into the new year in 2001. The model and the math focus on the hard data that barely budged during what appeared to be a strong rally. In that case, the rally was volatility to ignore. It was a counter-trend rally within the context of a new primary trend, which in this case was down. You'll notice in the entire bear market, the slope of the 200-day stays down, and the 50 for the most part has a negative slope, and the 50 never crosses above the 200-day during the entire dot-com bust. It's not always that easy. In this case, we're just using these to illustrate basic concepts. The model uses multiple inputs that rely on similar concepts. There's a long-term period here with sideways movement. When we get sideways movement, typically, as we've said for a long, long time now, Sideways markets and more difficult markets are typically followed by big moves. This, if we're looking at it from this perspective, can be absolutely maddening. But when we take a step back and look at the math, if the rules are properly followed and emotions are held in check and we stop watching our day-to-day account balances, the math catches the turn. We get a bullish moving average crossover here in early 2003, and a new bull market has started. In fact, the charts that we use to update the model, we often take price off the chart. This looks a lot more difficult than this. And if you were to ask the question, I don't understand what you're doing, this is what we're doing. Our objective in the markets and our objective with trend following with the market model is to participate in a long-term trend. We've removed the volatility here. This is the S&P 500 point to point from 1997 to the peak in the year 2000. This, if this is the way markets worked, would be very, very easy to manage. We would invest money and get positive feedback. So we'd stay invested. We'd invest more. We'd stay invested. Positive feedback. Positive feedback. It would be extremely easy to capture this. And when the top comes, the opposite would happen. We would begin to get negative feedback over and over again, and it would be easy to make the decision to move capital out of harm's way. Conversely, after the bottom here, balances start to go up. Your friends are making money. Everybody's talking how easy it is, and it's easy to stay in. Our goal is to stay invested during the primary trend while we're managing risk, and then to move capital out of harm's way as the math deteriorates, and then reverse the process here as the math starts to improve. This looks easy. This is why markets are so difficult. Rather than a point-to-point move, we have all kinds of volatility keeping us tossing and turning at night, balances swinging, volatility to ignore, primary trend, counter trend rally, volatility to ignore, counter trend rally, primary trend in this case is down. This is relatively difficult. The model and the math looks at it this way, which gives us a much, much higher probability of staying with the primary trend, properly recognizing a trend change, and then allocating properly for the primary trend, in this case, which is down, and then seeing the math switch over here in 2003. Can't emphasize enough, the model does not rely heavily on the 50-day and the 200-day, simply using these for illustrative purposes only. A fair question is, what happens if stocks do not trend again in 2016? The market model does not limit itself to stocks, and it does not limit itself to stocks and bonds. Similar mathematical concepts and trend-following concepts can be applied to individual sectors in the economy, such as energy, countries, Italy, Spain, Germany, regions of the globe, Asia, Pacific, commodity baskets, individual commodities, real estate investment trusts, all done via ETFs, the same trading vehicle. The math can't tell the difference between a REIT and a stock ETF. It can't tell the difference between a currency ETF and a gold ETF, but the math does allow us to compare them head to head from an opportunity cost perspective. So in a typical year, if stocks are moving sideways, typically something is trending, and the model is always looking for new trends. There are periods in history like the year 2015 when the Fed is changing interest rates where it's difficult to find anything that's trending. How do we know that was difficult in 2015? Worst year for asset allocation funds since 1937, which tells us there were very, very few sustainable trends anywhere in calendar year 2015. Is the security selection process or ETF selection process in the model broken? No. How do we know that? We showed in the year-end video that there was a handful of ETFs that did well. The market model correctly identified them. Clients will recognize many of these symbols when trends form. That will help us produce better results. The probability of all of these buckets here trending sideways and remaining trendless for the rest of eternity is extremely low. It's not zero, but it's very, very close to zero. So if we continue to execute, eventually some trends will emerge somewhere. They'll either be up or they will be down. Why does the model allocate based on hard evidence, and why do we constantly say we don't forecast and no forecasting? It seems like it would be easier to read a forecast for the year and allocate accordingly. Unfortunately, when we ask the question, how accurate or how useful are stock market forecasts from Wall Street professionals? A study was done from 1998 to 2013. It reviewed and tracked over 6,000 stock market forecasts from Wall Street professionals. So back to the question, how reliable or useful or accurate are forecasts related to the financial markets? According to the thorough study performed by CXO Advisory Group, LLC, the answer is about the same as flipping a coin. So they're not very useful. This is a quote regarding the study from Forbes.com. Therefore, when we see a headline like this, Goldman sees 11% upside on the S&P 500, which is a Bloomberg headline on January 14th, we need to take that with a grain of salt. That 11% upside, whether it's achieved or not, we could flip a coin. It's probably about a 50-50 proposition. That's why paying attention to the hard evidence rather than relying on forecasts, in our mind, is a much more logical and rational way to approach difficult markets. You can have the best probabilistic model on the planet, and if you don't execute properly, it is useless. Sound execution requires continued focus, confidence, and emotional stability. And a big part of that is insulating yourself from the noise and learning to ignore the noise. Why? The noise is all captured in price. If we pay attention to the trends and the hard data, we won't miss it, because if it matters, the market won't miss it. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.